Welcome to today's Dealsmaker event on the 2025 Deal-Making Outlook. I'm Dan Primack, business editor at Axios, coming to you from Boston. Big welcome to everyone who is joining us on X and Facebook and LinkedIn and YouTube and, of course, Axios.com. And you can join the conversation, particularly on X or Blue Sky, with @Axios or the hashtag Axios events. This is the last installment of our 2024 Dealmakers series, where we've been looking at major trends. So today we are going to look forward to 2025 to see what impacts on deals there will be. Our first guest is the co-founding partner of Floodgate, Anne Miraco. Anne, thanks for joining us.
Great to see you.
Great to see you too. So Floodgate is a seed stage firm. Let me actually start with this, which is, it used to be there were seed stage firms, and then there were Series A firms and Series B, and it went on and on. How do you distinguish right now between a seed stage firm and a pre-seed firm? Kind of where do you invest? Because pre-seed seems to have become a trend in 24 that I don't know if it'll continue into 25.
Yeah, so I think of pre-seed and seed actually as our core investment area, and I think of them in two very different ways. So pre-seed to me is actually the clock isn't starting for the founder, and you have the ability to play a little bit. And so when we're evaluating pre-seed investments, we're usually just looking at the founding team, barely looking at actually at their idea. I've told founders, hey, I don't even really love the idea you're working on right now, but I want you guys to play a little bit and figure out if there's a vector that you can travel on that might get you to a Series A. Then you've switched into seed mode. And so pre-seed to me is usually $1 million or less, gives you the ability to sort of putz around and make mistakes. And then seed is, usually somewhere south of $5 million or so, and allows you to get to the Series A, but you have to be on a direction that works.
Okay, so within your world, which is pre-seed and seed, what do you see as kind of the biggest development or storyline of 24? And is it something you see potentially continuing into 25?
Yeah, I'm going to take you back to 2006 to 2008. I know, Dan, you were a young journalist at that point. I was also starting out in my VC career. And in that time period, there's this thing, AWS, that launched. And I think, the reason why I started Floodgate was that we had this inkling that that was actually going to change the nature of why a founder might fundraise and how much they might fundraise at that time. I think the big story of 2024 is going to be written in a few years, which is that we're facing actually a very similar technological shift that actually changes the needs of the founders. So back in 2000 to 2006 to 8, you'll recall the original financing round was $5 million. You sold 50% of your company, and everyone was off to the races, and you tried to IPO at, I don't know, $200, $500 million outcome. And now what we're seeing is that there's this opportunity potentially with AI to also revisit, what do founders need, not only in their initial round of financing, but over the course of their entire startup story. And we might have very different types of startups in the future, some that are huge capital consumers and others that are actually very capital efficient. And so my hope is that we can have many different types of startups starting in 2024.
That's interesting, because when you talk about the capital efficiency and go back to AWS, a lot of that was being able to move from, having to have racks of servers in your office, which is VCs you were helping to finance, to being able to do that obviously off-prem. It was cheaper. You were basically borrowing them or renting them essentially. With AI, how do you, when you're looking as early as you look, particularly when you talk about some of those pre-seed companies where it's really the founder more than the idea, are you able, do you think, usually to be able to identify that this is going to be a company that's going to be able to use AI efficiencies to not cost as much to get to a period of scale compared to one of those, voracious capital users?
Yeah. So I'll tell you what, in my original pre-seed investing thesis, and when I look at individuals, there's really two types of individuals I've been looking for over the last, let's say, 5 to 10 years. And I call them two different types. One is what I call the super thinker. That's someone who is voracious about ideas. They are very curious and they're hyper persistent. And those individuals are true truth seekers. When they're coupled with what we call a super builder, and this isn't just your normal 10x engineer, but someone who is unemotional about building and also throwing away products, then all of a sudden you have this magic learning cycle that gets you to the promised land of product market fit. That's our theory, right? In this new era, what's been really interesting is that that concept of the super thinker and the super builder, how fast do you actually learn? And also, how fast do you build and what tools do you use actually can look very different. So I was recently at a hackathon that one of our portfolio companies put on. And what was really stunning was that there were some products that were actually being built within that hackathon that didn't have a single engineer. And so the concept of who is a builder is actually shifting pretty dramatically in the moment. And what tools do they use? How do they use it? Is actually also changing as well.
Does that mean you think, like, when you look at 2025 and into 2025 or even 2026, that you think a lot of your initial checks, or maybe if not even your initial checks, the Series A that you hope that these companies are able to eventually raise, are on average smaller than, say, they were over the past several years, kind of pre-AI revolution?
That's entirely dependent on the ego of the founder. I think some founders really do want to have that stamp of approval from a later stage investor with a name, and oftentimes those investors need to write a large check and take ownership requirements into consideration. But I think we're going to actually start to see other types of founders who really want to play the capital efficiency game. And they will have employees who are also savvy to the fact that a huge valuation is not necessarily working in their favor. And so I'm really curious to see if we're able to find companies where the founders and the employees are just a little bit more cynical and they're not thinking about each individual round separately, but rather the full spectrum of capital that they're going to take in as a company. And so we just believe that there's going to be major sectors where you don't need to have, 100, 200 employees right away, but rather you could actually stay pretty lean and build a successful and sizable business. So it's not just, you don't want to be not ambitious, you could be quite ambitious, but also very ownership sensitive.
How do you kind of parse out? It feels like to me, as somebody who writes about lots of deals every day and sees a billion press releases, that every single company now, whether it's a brand new startup or whether it's a legacy company that was founded 10 years ago, is now AI enabled, AI powered, an AI platform. AI is, how do you as an investor parse out what is a company that is either legitimately developing interesting AI technology or legitimately using it as core to their product, as opposed to those who are just trying to stamp on the buzzword for hype?
Well, I think like actually investing as a business hasn't changed. Maybe the technology, infrastructure, everything has changed, but I'm old enough to realize that real businesses are real businesses. You have customers who actually have a problem and you solve it for them and they're willing to pay for it. And a little bit of the hype cycle has been difficult to parse through because there are boards who are demanding that their companies become AI enabled in some way. And so there's a thirst for AI technology being inserted into larger corporations. But at the end of the day, I think you can't get away from the fact that you have to actually be solving a real problem with or without AI. And so, in many ways, even though sort of my technical and academic background comes from this sort of math modeling AI space, I oftentimes will ignore even the existence of that and really focus on what's the customer problem? How do we solve it? Is it being done in a new and innovative way? Are we really actually, using an inflection point that is unique? And does this founder actually have a real insight and a real secret? Because otherwise, you're just in mindless competition.
And one of the things we know is going to change in 2025 is who is sitting in the White House. When you think about this incoming administration, is there something that you think could have a tangible impact on the seed stage investing sector industry, as opposed to just, one particular company or another?
Yeah, I'm really interested in sort of our LP base and the impact it might have on our LP base. And I'm specifically thinking about endowments. There is a proposal right now to take the endowment tax from 1.4% to 35%. And most people would say, well, endowments are super rich. Why do we care? Well, they are huge limited partners in private equity, whether it's venture capital or not. And so it might actually really impact funding for these funds. But also, you think about the ways in which it'll impact founders and the technologies that we've invested in for so many years. You look at Stanford; they're in the 60th anniversary of AI, and that's the fundamental research on which everything has been built that we're seeing today. And so those are things that I think about quite a bit, not just for the impact this year, which we may see, but out 10, 20 years too.
Ann Mariko of Floodgate, thank you so much for joining us.
Thanks.
Next up is a view from the top segment with John Otto.
Thanks, Dan. Good afternoon. I'm John Otto. And thank you to our sponsor, Cooley, for making today's conversation possible, which is part of a year-long series we host together. So I'm excited to introduce our next guest, partner at Cooley, Kevin Cooper. Hi, Kevin. Thanks for being here.
Hi, John. Great to be here. Thanks for having me.
Appreciate it. We've got plenty to cover, so let's get right into it. We heard a lot about the chilling effect that aggressive antitrust enforcement had on deal making under the Biden administration. What does the incoming administration mean on that front? Should we expect scrutiny to loosen?
It's a really great question. I think, we heard a lot about over the past 4 years how the Biden administration is very aggressive on antitrust enforcement. Lena Khan and her leadership of the FTC received a lot of headlines. And in part, those headlines were for the agency's pursuit of many novel and untested theories of antitrust enforcement. And look, while the Biden administration wasn't always successful in challenging M&A deals under those theories, certainly there was increased cost and risk associated with doing transactions and likely a chilling effect where people decided not to pursue something in that environment. But looking ahead, I think it's sometimes easy for people to say, well, now that we're moving out of that administration and into a Trump administration that, look, Biden and Trump, very different politically in a lot of areas, certainly. I think it's sometimes easy for people to conclude, well, maybe we should expect a 180 on antitrust as well. And we would actually say not necessarily. Look, we certainly overall expect a more constructive environment for deal making. The Biden administration was particularly challenging on antitrust. But we also have a situation here where prior experience can inform our expectations looking ahead, and that's the prior experience of the first Trump administration. And when you look back at that administration, by many accounts, the Trump #1 administration was actually a more aggressive enforcer on antitrust than the Obama administration was. It was not kind of a Ronald Reagan style, very permissive antitrust environment. And in fact, recently when Trump named Gail Slater to be his nominee to lead DOJ antitrust, he went on social media and said that he will ensure that our competition laws are enforced. He did say they would be enforced both vigorously and fairly, and called out that there will be clear rules that facilitate rather than stifle the ingenuity of our greatest companies. This is a direct quote from Trump's statements. So that could be something of a signal that the Trump administration could be looking to get back to pursuing more kind of traditional theories of competitive harm, focus on horizontal overlaps, move away a little bit from some of the more kind of creative theories that we saw the Biden administration pursue. Could also be a sign that they may be more open to accepting remedies or settlements where there are, antitrust issues, but that if something is tailored appropriately, it could allow a transaction to still go through. But overall, look, time will have to tell. Some more certainty around those dynamics could somewhat reduce the chilling effect, but overall, we do not expect in this narrow area of antitrust for Biden, the switch from Biden to Trump to be a complete 180. We should still expect a robust antitrust enforcement agency.
And let's take a look at a few industries. So does this mean that big tech M&A activity is back?
We're optimistic that overall in the tech sector, we'll see activity continue to increase as that environment comes out of a particularly depressed state over the past couple of years. But we would not necessarily, again, expect, an opening of the floodgates for big tech in particular. And that, again, looks back to, what we saw with the first Trump administration and their, real focus on big tech. Again, to kind of go back to Trump's own statements in this area after the election, he also said when he was announcing his nomination of Gail Slater that quote, big tech has run wild for years, stifling competition in our most innovative sector. And then he went on to refer to big tech impermissibly using market power to harm little tech. So look, I think that a lot of that does refer to non-M&A. There's a lot of kind of just monopoly type antitrust enforcement actions going on that are expected to continue in the new administration. But that overall scrutiny on big tech will certainly impact their ability to look at M&A as well. We'd also expect in the Trump administration cross-border deals to be, facing particular scrutiny, as well as transactions in spaces like semiconductors and social media, which are big political focal areas for the new administration.
Beyond those two industries, that was a question I was curious about too. Where else we should be looking under a new administration next year? What other industries beyond semiconductors and a few others you just mentioned should we be watching out for?
Look, we're focusing on the life sciences sector as well, particularly expecting, in pharmaceuticals there to be, continued momentum in that sector. There is, a lot of cash sitting in big pharma to be deployed, patent cliffs approaching, and companies needing to refill their pipelines with new and exciting drug candidates. That's also a space where we particularly saw the Biden administration focus a lot on scrutiny of partnerships and licensing transactions, which, given that those often lead to M&A, may have been stifling M&A itself to some degree. We expect that it's certainly possible that the Trump administration will pull back again from some of those more novel theories of enforcement, and we could see at least for kind of modest sized transactions, maybe slightly less risky bets in light of some of the activist pressures in the space and market pressures. But we could see the life sciences industry really kind of continue to be on the uptick in terms of deal volume.
And the past few years, we've seen a downturn in large deals. So, looking ahead as we finish up, a big question here is, are mega deals back on the table?
Yeah, time will tell. I mean, certainly we're seeing a more conducive macroeconomic environment to large transactions coming up. I think that inflation by and large globally is starting to feel under control. There's less volatility with respect to interest rates or just overall kind of declining interest rates looking ahead. And that environment, in addition to leading to a lower cost of capital, perhaps making debt financing more available on attractive terms, really just overall in terms of stability, helps facilitate board and CEO confidence, which is really what drives risk-taking and M&A in a new environment. Certainly, there's also areas in AI, security, power infrastructure, where there's a lot of pressure for companies to pursue real capital investment, and M&A can be a part of that. On the other side of the coin, this regulatory environment we've been talking about is not just a U.S. issue; it's a global issue, and the increasing kind of scrutiny and complexity of global regulatory regimes will certainly be something that deal makers have to navigate. So it will certainly be a very interesting year ahead, and we will have to see where the macroeconomic environment and those real business imperatives drive some companies to potentially say, hey, I'm willing to be one of the early test cases in a new regime and pursue a major transformative transaction.
Well, that's all the time we have for today. Kevin Cooper, partner at Cooley, thank you again for your support and for joining us at Axios.
Yeah, thank you. Always happy to do it and great to see you.
Likewise. And next, back over to my colleague, Dan Primack.
Thank you, John. Our final guest today is FirstMark co-founder and partner Rick Heitzman. Rick, thanks for being with us today.
Hey, good to see you, Dan. Hope all's well. Yeah, we're excited to be here and excited for 2025.
So let's talk about 2025 and kind of in context a little bit of 24. And something I know you and I have discussed over the last couple of months from time to time has been that one of the trends, if you want to call it, in venture capital of 24 is that very few VC firms got out of their existing portfolio companies from kind of the free money era of 20, 21, 22, either via IPO or acquisition. Do you expect that is going to change in 2025?
It'll change a little bit, but probably not as much as any of us want. So, everyone's been waiting for the IPO spigot to open. I think we're seeing ServiceTitan now begin to kind of crack that door open. But in large part, I think the IPO window will open in Q2-ish of 25 and be open, but there won't be enough room in that spigot to let everybody through. So there's going to be a lot of companies that are still going to have to deal with the sorting of, are they worthy to be a public company, and can they do a good M&A deal? If not, what's going to happen to them?
For you, when you think about your portfolio or FirstMark's portfolio and kind of the later stage companies, what makes a company IPO-able next year, in your opinion, as compared to those that might not be?
Yeah, I think it's going back to the core elements. Are you growing at 30+%? Do you have scale of at least probably $200 million for most enterprise and consumer companies? We'll leave AI out of it because that's a totally separate beast. Do you have good unit economics, and are you a Rule 40 company? And then around that, do you have a big enough TAM that if a large public investor, a Fidelity of the world, was going to buy your IPO at a $3 billion valuation, can they see you growing to a $10 billion company? And those criteria, which were some of the classic criteria, got way skewed in 2021 and 2020. And I think you're going to go kind of back to basics. And once that's reset, I think some people's expectations will have to be reset also.
For the group of companies that can't go public, or at least don't think they can be in that, and that aren't hyper growing like some of the AI companies, call it the stranded unicorns, if you will.
Yes.
What happens to them in 2025?
Well, it's going to be a tale of two cities, right? So some of those companies, well, actually probably three different things could happen. 2025 is really going to be a year where we're going to really find out what happens, right? The tide will go out and we're going to see who's wearing swimsuits. And there's going to be some companies across the board who are going to really execute it incredibly well. And they've either found a niche, which might be non-obvious, or had a great market. They got lean, they got efficient in 2022, 2023, and 2024, and now they have a great business coming out the other side. And that great business could be IPO-able or incredibly attractive, what's going to be a much more open M&A market than we've seen in years. The second group of companies are going to be, they got decently there, they're not burning any cash, but they're kind of uninteresting. That you might be growing 15% a year, you might have been worth $2 billion a couple of years ago, but now you're a $40 million revenue company growing at 10 to 15% a year, cash flow neutral. And those companies, I think it's important that you find a home for them. You can let them kind of wander around as almost a zombie. But I don't think that's in anyone's best interest, from LPs who want that capital return to even entrepreneurs whose most valuable asset is time, and it doesn't make sense to waste time on them. And then the last bucket are companies who still haven't gotten fit, still are burning cash, might have been worth a lot, might have had a lot of cash a couple of years ago, but have burned through that. I think it's going to be a really tough year for them. I think there's going to be a lot of companies whose M&A departments have ramped up, but still are going to have too much opportunity, and those companies will be sold for little or nothing. Even as we've seen recently, companies that raised several $100 million are going to go away.
For that second bucket, the ones you said we're going to have to find a home. Private equity obviously is one potential home. Corporate strategic acquirers are another home. Do you expect next year, and I know there's some conventional wisdom on this, so I'm curious where you're thinking, do you expect that when it comes to tech companies, that the Trump administration's antitrust regime is going to be looser than the Biden administration's antitrust regime has been?
Much. I think much looser, especially for kind of small M&A. I mean, if you think about Sachs going there, the impact he'll have. I think Lena Khan was one that had one of the tightest limitations, even if you think about Amazon and Roomba and some of the other things, which probably didn't make sense to have the consumer protection really focus on. So there'll be more opportunities to do acqui-hires. And I also think there'll be more opportunities for the non-hyperscalers, the non-Googles, non-Microsofts of the world, to be able to buy companies that fit a product niche or could build out a team that those companies are better part of a larger ecosystem.
Rick, last question on distributions, or kind of that whole concept, which is, do you feel when you talk to your peers, your other venture capitalists, is there any feeling that kind of how I seem to feel, which is that 2025 is a make it or break it year almost for the industry? Caller Capital came out with its annual or biannual barometer the other day and talked about how a lot of limited partners say we're no longer going to recycle cash or distributions for venture capital firms. We want our money. We're done with you. It does feel to me like if distributions don't really pick up, that a lot of firms could disappear. Is there fear in the VC market over this?
There's some fear. I mean, we've said for years that this has been the biggest correction since 20 years ago, and we lived through that. I invested and operated through that, and that took almost a decade for that market to come back. And what you're going to see is there's going to be a handful of firms who kept their brand promise, who took capital from LPs, were able to return that capital, were good stewards of that capital, and they'll persist. And they'll be either two buckets. They could be the large hyperscalers, the Sequoias, the Andreessens, the General Catalysts of the world, or there'll be more firms the size of Firstmark who have a good sized firm that can support their entrepreneurs. They're not too big. Those companies matter, but we have a good motion of both deployment and returning of capital. The people that are going to get caught are new firms who have a really hard time with DPI, or firms that didn't really hold up to what they said they were going to do with the LP's money. So they had scope creep. They hired too many people too quickly. They got into sectors they didn't understand. They got into deals they didn't understand. They got into access funds or something else where they were pulling more LP's money in at a very high price. People don't forget those things. And I think you're going to see a washout of approximately half the firms across the board whose LPs are exhausted by having to ask them for cash or having to remind them what they promised them when they first got the cash.
Rick, when you look at 2025 in terms of new or potential new investments for you and Firstmark, is there an industry or a sector trend that you're particularly excited about that maybe you weren't thinking about or weren't excited about going into 2024?
Have you heard of this thing called artificial intelligence?
Yeah, I read something, there was a headline in a paper or something.
I turned on my computers everywhere. No, I think AI is going to be all over, and I think all over being continued to persist.
What does that mean? Can I ask, Rick, what does that mean to you? Like, where within AI? AI is a big thing. There's obviously the foundational models and applications in a variety of industries. What within AI interests you particularly?
So the most exciting thing for us, so it was a broadly all the stack of foundational models, application layer. What we've been the most disappointed in over the last couple of years as it relates to AI is consumer AI. And we've seen some things, ChatGPT being a great consumer application, Perplexity, but we haven't seen AI really doing work for consumers. And we've seen a couple little things on travel. We've seen some things that loop applications together or maybe provide some suggestions. what we're really hoping to see, and we just had a meeting this morning of where we're really doubling down to look for entrepreneurs who are using AI to solve consumer problems and really doing jobs for consumer. If there's something that I'm most excited about is, hey, I've been disappointed thus far, but I think we're going to see some great entrepreneurs doing great stuff on consumer AI, doing real jobs for people that they're going to be willing to pay for.
Rick, final question. The person who I spoke to earlier today, Ann Miraco, she made a comment about how she views this almost as an AWS moment for startups. When AWS showed up, suddenly startups were able to build a lot cheaper. And she feels that AI is that too. Do you agree with that? And I guess the reason I ask is, could that mean that Series A, Series B rounds are smaller in terms of dollars than they were a couple of years ago, not because of a lack of ZERP, but because of the actual technological changes underpinning?
Well, I hope that's true. I think that, I like going back, and a lot of great companies were built either after the financial crisis or after the tech drought of 20 years ago, because that capital efficiency is so core to having focus at the earliest stages. So I hope that's true. I don't think it'll be such a mega trend. I think that, coding assistance will be helpful. Some models will be helpful. It'll provide some additional efficiency, but it won't be so efficient that it'll fundamentally change the financing dynamics.
Rick, thank you so much for joining us.
Thanks, Dan. Great seeing you.
And thank you all for joining us this afternoon for another Axios Dealmakers event that has made everybody smarter, faster. For more on what's next across deals and deal making, please sign up for the Axios Pro Rata newsletter at getprorata.axios.com. Thanks all for joining, and we'll see you next year on Axios.com.